Welcome back to NYSE Live. Well, here to talk markets, of course, as the Dow Jones Industrial Average surges 1,300 points, and the major indices across the board are seeing gains of more than 2% amid the reopen of the Strait of Hormuz, is David Busch. He's a co-CIO at Trajan Wealth. David, great to have you on the show this morning, joining us from Phoenix. I know it's hot down there, and these markets look pretty hot right now. What's your take?
Well, first of all, thank you so much for having me. Yes, geopolitical risk has been the biggest talking factor or the biggest market factor over the last several weeks. And with the reopening of the Strait of Hormuz, we see the price per barrel is down roughly $20 a barrel of oil. And that's adding a tailwind to the equity markets this morning.
A tailwind that we see very strong indeed. What's going to be important moving forward? Are you watching the minute-by-minute headlines?
You know, it's difficult because headlines, we do want to understand what's happening geopolitically and across the globe, but also there's a lot of headline volatility. And so without a clear resolution to the war in Iran, we're going to continue to experience that volatility. And what I've been relaying to the people that I speak with is with that volatility, the important thing is to be patient, think long-term, and stay invested, because we are going to continue to have this volatility.
So volatility is here to stay, certainly disruption as well. I do want to talk about some of the data. What's on your radar on that front, simply because we know that the data will impact the Fed's rate decision, and that does have an impact on the price forward for equities. When it comes to the inflation data on Friday, what's on your radar?
So some are estimating that there's going to be a 1% increase in CPI for this week's CPI release. And ultimately, if you're the Federal Reserve, you've got to be sitting back wondering, okay, how does this thing end? How do we view this inflation, this spike in inflation? Is it temporary? Are we going to see inflation pull back after this larger print? But if you're the Fed right now, there really is no impetus to cut rates because of the inflation uncertainty, not only just the price of oil, but also tariffs. And so that has to work through the economy, and the unemployment rate's still low. So we're really at a point where the Fed has to be in a wait and see approach, because that inflation is coming.
Yeah. You know, a lot's happened. It hasn't even been a week since Good Friday. The stock market was closed, but we did get what was a much stronger than expected March jobs report. 178,000 jobs added last month. The Fed has a dual mandate, obviously inflation and jobs being that second component. How does that factor in to your outlook and recommendation for stocks that there does seem to be a cushion in jobs?
Yes, right now the unemployment rate is still at 4.3%. We have solid GDP. The key factor here is the inflation data. And so from my perspective, it's thinking about diversifying across sectors. So on one hand, I still am a firm believer in the long-term benefit of large cap tech specifically, but also looking down to that second layer. If we remove the Iran war, we get back to fundamentals. So we're looking at the AI infrastructure build out. Now, who's going to be the beneficiaries of the AI infrastructure build out is all of the traditional bellwether sectors. So this is industrials, materials, energy, utilities, and so on. So that value tilted dividend payer, like the historic bellwethers of the market, those should continue to benefit from this AI infrastructure build out. So it's really just maintaining that balance between that growth and value tilt.
Yeah, of course, corporate earnings are going to kick off the reporting season. That is really in earnest here over these next few weeks. What are you going to be watching when it comes to these results?
The main thing is to see the impact of the inflation data, tariffs on the consumer, but also looking into next week. Let's think about which of these companies are going to give us an insight into the health of the consumer, because right now rates are still high, prices are still high. So the consumer is 65-70% of the economy, and if the consumer pulls back because of these higher prices and higher and higher rates, then consumer discretionary may lag, whereas consumer staples will do well. So that's really what I'm watching for is how does this benefit or hurt the consumer in each one of these announcements?
All right, David Busch, co-CIO at Trajan Wealth. Thank you so much for joining us this morning from Phoenix. We appreciate it.